Derek, what is my worst case scenario? For many pre retirees, they like to have a plan in place that is going to provide them with a lot of confidence, clarity, and very little stress when it comes to retirement. After all, people don't work their entire lives just to get to their golden years to be full of uncertainty and not know what's around the corner. So, for a lot of pre retirees that come to me, one of the big questions they ask is, Derek, what happens in retirement if we hit that worst case scenario? What happens if we retire and then a month later another great recession hits and we see investment markets drop like a rock or inflation ignites again? How will that impact me? How will I know what actions I need to take and when? And ultimately, do I have to worry about finding a job or a career 2.0 after I already have retired? These are great questions that every pre retiree needs to ask and every pre retiree needs to plan for before they pull that retirement trigger. My name is Derek Delaney. I'm a certified financial planner, owner of PharmD Financial Planning, and this is what I do for a living. So let's jump in and let's talk about one of the biggest risks pre-retirees or newly retirees face when they pull that retirement trigger. And it's one that a lot of you have probably heard about before, and that is sequence of return risk. Essentially, what sequence of return risk is you being unlucky that when you start retirement and start withdrawing from your retirement assets, you do so during a period when the value of those investments are dropping. How do you make money in the stock market? Well, you like to sell high, buy low. But in retirement, as you're in the deaccumulation phase, you are continuously selling in order to pay yourself in retirement, and you are selling from those assets you've spent the last 35, 45 years accumulating. So if investment markets are down and you are actively selling out of those portfolios, you are now locking in those lower prices and essentially locking in losses. And if you do that at a substantial rate early in retirement, it means that when investment markets recover again in the future, that recovery happens on less investment money because of the way you withdrew a lot of it in the early years, meaning that you could get a great average rate of return, but those higher returns are on less dollars, meaning that you are going to most likely find yourself in some sort of shortfall or squeeze later on in retirement when it comes to your retirement income plan. So simply put, that is sequence of return risk, and that framework is the reason why a lot of retirement income plans or strategies have been established. Some of the most common are the 4% rule, meaning that if you withdraw only 4% of your retirement nest egg every single year, and then you get inflation adjustments on that withdrawal rate, even if you experience the worst case scenario in retirement, like a Great Recession 2.0, you're not going to have any sort of long-term financial difficulty because that withdrawal rate is low enough where you're not putting enough stress from a withdrawal standpoint on your investment portfolio for it to matter, even in worst case scenario situations. Another unique and popular retirement distribution plan is for people to create a big treasure trove of cash in a safe account that they plan to withdraw from if an economic disaster were to strike. So let's just say you retire and the Great Recession 2.0 happens all over again and the majority of your investment portfolio starts dropping and you go, I don't want to withdraw from that money because then I'd be locking those losses in. Let me go over to this big pile of cash I have set aside, maybe 3, 4, 5 years worth, and start withdrawing from that until this investment portfolio I have over here starts to recover. And that may seem like a really good idea, but from a technical and an administrative standpoint, that gets very difficult to manage because as you're slowly withdrawing that cash and your investment portfolios continue to drop, it means that your portfolio gets riskier and riskier and riskier as you're spending down that cash and as that investment portfolio continues to drop, which means that you will have to rebalance that investment portfolio and retain a lot more risk as you're spending down that cash, which can be the complete opposite of what most retirees are comfortable with, which is why a typical and systematic rebalance could ultimately work better in that given scenario. And it leads me to the last and a new and what I think the most appropriate type of retirement income withdrawal strategy is, and that is to place some sort of guardrails around your withdrawal rate. So if you start retirement, you're withdrawing 5% of your portfolio every single year, and that investment portfolio goes up in value. How far up in value does that investment portfolio have to go in order for you to get some sort of income increase? On the flip side of that, if your withdrawal rate is 5% and we hit some sort of economic disaster and the value of your portfolio drops dramatically, how big of a drop will you have to experience in order for you to be forced to take some sort of small and temporary income cut? And those guardrails will be there to help signal immediately which one of those two options you should initiate given the economic circumstance we're in. So if we look at that guardrail strategy, we can then take that and we can test it, stress test it, based off of every single economic condition or economic disaster we've experienced over the last 100 years, right? So that's what I want to model for you next to show you how stress testing a portfolio within that retirement guardrails framework works and how I utilize that in my retirement planning practice. So if we jump in and we take a look at this household and we assume that they have a $2 million retirement nest egg. And they go, hey, Derek, we have $2 million. We're going to retire. But before we do, I want to see what worst case scenario could look like. What if we experience another global financial crisis like we did from 2007 to 2009? Now, during that global financial crisis, some investment portfolios and some indexes dropped over 50% during that time period. And unemployment hit a top of double digits, over 10% in 2009. And a lot of the investment markets did not fully recover until some point in 2013, 2014, right around there. So if we were to experience that type of situation again, how would this retirement portfolio fare? Well, we could come down here, and what this software does is it will run your expected retirement balance within that guardrails framework over a number of different rate of return scenarios, including this global financial crisis. So given how they're invested, which is pretty moderate, currently in this scenario, they are a 60-40 portfolio. You can see here that before the global financial crisis starts, they have the ability to spend at exactly what their planned income is. So their planned income in retirement is designated here by this light blue color, and the actual income they can spend is highlighted by this dark blue color. And you can see here that they're rolling along, and then the financial crisis hits in October, investment markets start to drop, and they hit this first little guardrail here, that lower guardrail, signified by that red spotted line that says, hey, Mr. and Mrs. Client, we've experienced some really tough investment markets and your portfolio has dropped quite significantly, where we need to temporarily lower the income you're taking out from your portfolio. We want to reduce your withdrawal rate based off of what your current portfolio balance is at this time. So they take a little bit of an income cut, and over these next couple of years, they are forced to withdraw about $1,100 to $1,200 less than what they thought they were going to at this point in retirement. And then all of a sudden you can see here that we get to June, July of 2014, and all of a sudden their investment portfolio now has actually gone up enough where now they get that income increase because now they're hitting that top guardrail. So now they are back to what they thought they wanted to spend. And you can see here, after that point in time, there's not another economic situation that took place after the global financial crisis that forced them to take another spending cut in retirement. So you go, great, the global financial crisis, that works great. I'm glad we understand if we were to experience that again, what type of income cut we need to take temporarily, given what those guardrails tell us we have to take from an income cut standpoint during that economic situation. Well, let's look at other economic disasters that have taken place in the past to see if they would produce the same type of output. And you can see here, same thing applies if we were to experience another stagflation era in the late 1960s and into the 70s, where interest rates spiked to almost 17% during that period, and inflation peaked at 14% in 1980. Well, if we were to experience this again, you could see here that given those guardrails in place, you'd actually have the ability to spend what you'd want to spend until we get to about late 1970s. And because of that inflation and because of that stagflation and performance of the portfolio, you'd have to take 1, 2, 3, 4 income cuts over the course of those 4 years below what you anticipated wanting to spend, which is your planned income during that time period. But you can see here, once now you are at that lower income range, it gives your portfolio a chance to catch up after these poor economic conditions played out. And you can see that after a while, you find yourself back at what your initial planned income goal was later on in retirement here. So you can see even during a stagflation era, the way they anticipate these clients wanting to withdraw money, they could expect to experience a couple of income cuts, meaning they would hit that bottom guardrail and temporarily have to spend less in order to ensure that the rest of their retirement from a financial well-being standpoint would be just fine. So you know what has to happen during the global financial crisis. What about the Great Depression? You can see here that even if we were to hit the Great Depression, given what this client's financial situation is, they would have to take one income cut, which is about $400 to $500 less than what they want to spend over a small period of time. And when that economic distress goes away, they have the ability to comfortably and confidently from that point moving forward spend exactly what they thought they wanted to spend in retirement. So this is stress testing a retirement income portfolio with a specific guardrail strategy in place that provides a lot of context and provides a lot of clarity on what potentially a client or a client household would have to give up from an income standpoint over a given period of time if specific economic disasters were to take place. And if these guardrails are in place, these economic disasters would not be a complete wipeout of their retirement. Instead, the complete opposite would happen where they would know instantly what action they would need to take. For most people, it would be an income cut for a short period of time in retirement to ensure that the rest of their retirement income, retirement plan, and retirement life would be sufficient even after experiencing those economic disasters of the likes we've seen over the last 100 years. So retirement income is a very important piece of the retirement planning puzzle. A distribution strategy as part of that retirement income plan can be very, very important. In my practice, I utilize those guardrail strategies. And for my clients, utilizing those guardrail strategies to help them determine when they get an income increase or an income decrease, and being able to project that over some of the worst retirement economic disasters we've experienced over the last 100 years provides them with a tremendous amount of confidence knowing that if these economic disasters strike again, they have the ability to cut their income and they know roughly what time period they're going to have to reduce that income by in order to make the rest of their retirement sufficient and enjoyable for the next 10, 20, 30 years. Mike Tyson said it perfectly where he said, everybody's got a plan until you get punched in the face. Economic disasters could happen tomorrow. It could happen 5 years from now. It could happen 10 years from now, 20, 30 years from now. We don't know. But what I know is that most retirees, especially early in retirement, don't want to face that sequence of return risk. And they want to plan that after they get punched in the face, they know exactly what action steps they need to take in order to sustain that poor economic environment and not only sustain, but come out better than they were before for the long term, which is exactly what stress testing a portfolio within those retirement income guardrails strategy can do. If you're interested in learning more about how your potential retirement could fit into this type of distribution strategy, click the link below, schedule your complimentary consultation with me. It's a 25, 30-minute conversation where I can help you better understand how this specific strategy could help you create a strong, stress-free, and confident retirement income plan, short and long term, regardless of whatever economic circumstances are put in front of us over the next 10, 15, and 20 years. So click on that link, schedule your consultation, and until that conversation, happy planning.